Our next example here is for FVOCI versus amortized cost. This time it's serial bonds. Remember, if it's serial, our principal is being paid in a series of payments. So where is that sentence? That is here. You might as well underline it, right? 1 million worth of principal will also mature annually every year end. So the bonds have an effective yield of 8%. Let's see the business model. The business model of this is to collect contractual cash flows until maturity. So because of these key phrases or key phrase, we would say that our business model is hold to collect until maturity. Therefore, the treatment is amortized cost. We have a slight problem here. We know the face amount, but we don't really know the purchase price, right? So that's what we need to figure out first. A while ago, I have mentioned you the mnemonic, right, called MADCOP. Still remember this from a couple of videos ago? For MADCOP, if our market rate is greater than our coupon rate, there is a discount. Let's see here. Our coupon rate is 10%. And our market rate is 8%. Therefore, that's our clue. Our investment is issued at a premium. This means that the cash received is greater than the face amount. So it should exceed 3 million. Okay. So we need to conduct and compute for the purchase price, and that would be based on using the present value factor, which is based on the effective rate. So take note of that. In getting the purchase price, use effective rate. And we are using 8% here this time, not 4%, because the interest is being paid annually. So let's see. In 2022, we will pay the interest of 10%. Since we have not paid anything of our principal yet, the carrying amount of that would be 3 million, right? So 10% times 3 million, our interest for 2022 would be 10%. Once again, we are paying 1 million worth of principal every year, right? So next year, it would be 10% multiplied by 2 million. And for the last year, that would be 10% times 1 million. So our interest this time, notice, it's going down and down and down because this is a serial bond. A while ago, in the term bond, in the first example, the interest received is the same, right? So for this one, it's decreasing because we are paying off our principal every year. Principal, 1 million, 1 million. So our total amount is 1.3 million, 1.2 million. Oops. That's our total payment. Since our total payments change every year, we would use PV of 1, 8%. Okay? So this would be based on your amortization table, which will be given to you for your exam, right? So just in your exam, if you are part of my USLS students class for Accounting 203, you would use the 3 decimal point, the entire factor regarding that particular rate. Okay? Do not manually compute. Do not round off. Just use the rate that you can see from the amortization table. Nevertheless, that would be 1.08 raised to -1. So don't mind these computations. Okay. So let's see here. So this would be this multiplied, right? So this would be the PV amounts. We multiplied each amount by their corresponding PV factor. Again, what it's saying is the value of 1.3 million, which we will receive 1 year from now, today, the value of that is 1.2. The value of 1.2 million that we will receive 2 years from now, the value of that money today is 1 million. That's the application of time value of money. So indeed, our purchase price is greater than our face value. Therefore, we have a premium amounting to 105,725.75. Next up, we will now prepare the amortization table. Remember that, right? Under amortized cost, you are highly advised to prepare the amortization table. So you will just compute further balances at one time. Initially, our balance is 3,105,725. Once again, interest received is based on face value multiplied by our interest rate 10% stated rate, right? Our interest income is based on previous balance multiplied by the effective rate of 8%. So the premium amortization causes our balance to decrease. Our principal payment, of course, causes our balance to also decrease. And so, interest received, let's just copy based on the purchase price calculations. The interest income is this multiplied by 8%. The difference would be a deduction as well as the principal. For the principal, it's always 1 million every year. Since this is a term bond, this should be zero. Oh, sorry, this is a serial bond. For serial bonds, since the principal is being paid period per period, at the end of the amortization table, the last line balance should be zero. Right? Because we paid off the entire thing. Let's see here. So our balance at the end of the year, after considering the premium amortization and the principal, is 2,054,183.81. So the interest income in 2023 is now 164. Wow, that's much smaller, right? The premium amortization is 35. And once again, the balance would be the previous minus the premium amortization minus the principal payment. Lastly, for December 31, 2024, again, the interest income is 8% of the previous balance. The balance, the premium amortization is the difference. And therefore, our balance is indeed zero. See? So we would now use this amortization table to come up with our journal entries. And since we are accounting for this as an amortized cost, we don't really mind about the quote, whatever, right? We just know and we are just sure that we are accounting this for our investment in bonds. Cash, it's entirely based on the amortization table. So this should be fast because we already have the numbers that we need. Notice, December 31, 2022, debit cash, credit interest income. That would be 300,000, 300,000. For the premium amortization, again, premium amortization decreases our balance. So this is a deduction to both the interest income and our investment in bonds. And notice, right? Indeed, when you combine the interest received and the amortization, whether it's a premium or a discount, you would always come up with the interest income, right? 200 minus 35, 164. 100 minus 18 is 81, right? Interest received plus the amortization. If it is a discount, interest received plus discount amortization is equal to interest income. But if it is a premium amortization, interest received minus premium amortization is equal to interest income. So for the first year, that would be 51. And for the principal payment, that would be debit cash, credit investment in 1 million, 1 million. And this should be quick for 2023, right? For 2023, you can redo the entries. Same account title, same interest received. Just kidding. Since this is a term bond, serial bond, careful, your interest received would decrease, right? Because you reduce your principal. We paid off 1 million of that, so now it's just 200. Alrighty. And then the amortization on 2023 is 35. Just change the date. Hold on. And the principal payment. So for the principal payment, another 1 million and 1 million, right? It's all of these amounts are based on your amortization table. You don't need to do the journal entries in order to satisfy the requirements here, right? But what's important is you prepare, once again, the amortization table. So the carrying amount on 12/31/2022 is 2054. The interest income on 2022 is 248. You see how easy this is now? Because we have accomplished the amortization table. The carrying amount on 12/31/2023 is 1 million. The interest income is 164. How much is the amortization? In 2023, it's 35. How much is the interest received? In 2024, it's 100. So it's just a matter of looking at the right place in the amortization table. Maybe if you are looking for a JOA, maybe it's also in the amortization table. Maybe it's this one, which is not. Anyway, so now that we have accounted for it under the amortization cost or amortized cost method, how will this problem be different if it is classified as OCI?